Hello and welcome to Portfolio Matters. It's been another volatile couple of weeks in the markets, but before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, there's been a lot going on. So it seems a long time ago now, but 2 weeks ago, the US and China essentially agreed a 90-day truce in the trade war just after we recorded the last weekly. And that meant US tariffs on Chinese imports will fall from 145% to 30%, and Chinese tariffs on the US will fall to 10% from 125%. Markets took off. So there's much talk these days of the taco trade. Trump always chickens out, and that appears to be true. So he then went on to announce 50% tariffs on the EU starting from the 1st of June. And he then had a call with Ursula von der Leyen and delayed it to the 9th. The EU has suspended retaliatory tariffs, and Trump has subsequently announced positive progress. The markets do not think those tariffs are going to happen. Once again, he sparked a sharp sell-off from which markets have now recovered. The UK and EU have agreed a new trade deal. The US House of Representatives have passed the One Big Beautiful Bill, which will roll over US tax cuts from 2017 and increase the deficit. We have a segment coming up on that. The budget debate will now move to the Senate. Now, in the House, fiscal conservatives were threatening to derail the bill. Trump went to talk to them. They caved in. I suspect the same will happen in the Senate. The war in Russia continues, so Trump's promise to end the war on day one of his presidency is not looking very clever. Elsewhere, Moody's downgraded the US's credit ratings to AA1 from AAA and is the last of the big three credit rating agencies to downgrade the US debt. It has warned that it expects the US fiscal deficit to widen to 9% of GDP by 2035 due to higher interest expenses, entitlement spending, and low income generation. We have a segment coming up on the Big Beautiful Bill and its effect on the US fiscal position. The global bond bear market continues, and Japanese bond yields have continued to rise. And finally, the US Supreme Court has ruled that the Fed governor cannot be fired by the president. That is good news for central bank independence and for US monetary policy. Now, moving on to economic news, we had US inflation numbers for April, which came in soft. So prior to tariffs, the US inflation situation looked good, but true inflation is rising again, and it looks like the effect of tariffs is now starting to come through, and US inflation will start to rise again in the coming months. UK inflation numbers in April came in hot, with CPI rising to 3.5% and core to 3.8%. These are bad numbers, and inflation is expected to keep on rising in the next couple of months. So we will face a few months in the UK where inflation is likely to be flirting with 4%. Not good. Now, the cause of the big jump in UK inflation in April was largely due to one-off factors such as a 26% rise in water bills. We'll go through the numbers in detail in a bit. But bottom line, services inflation is not coming down. It's way too high and not coming down. UK earnings growth fell to 5.5% in March, but that missed expectations and remains way too high. The public sector pay settlement for the coming year was expected to be about 2.8%. It's now around 3.5%, and that will tend to cause inflation to be persistent. US PMI strengthened and returned to expansion territory. The US economy seems to be doing just fine. And if the big, beautiful bill passes and increases the deficit, it is very difficult to see how the US can go into recession, given it'd be running a deficit close to 7%. UK PMI strengthened but remained below 50. EU services PMI weakened sharply to below 50, so the EU economy appears to be slowing. Some charts related to the news. Well, this is the taco trade in action. Trump announces that he's going to put 50% tariffs on the EU, markets tank, but then he has a call with Ursula von der Leyen. It seems the tariffs are unlikely to occur. Markets swiftly recover. Now, this is the tariffs between US and China, and they have come right back down following the truce, which is not permanent, but it's likely to lead to some sort of settlement, with tariffs being much lower than their peak. And as a sign that the pause in the tariff war is leading to recovery in trade, this is China to US container rates. They're rising again. Trade is resuming. Now, the big, beautiful bill is working its way through the US Senate now. And the US is on a totally unsustainable fiscal path. And the problem is the bond vigilantes are saddling up, but Donald Trump is not listening. How high will bond yields rise before it forces the US government to change course? So Moody's have downgraded the US's credit rating. Take a look. Germany retains its AAA credit rating from all the three major credit rating agencies. The US does not. The UK is well down the list, but above Japan, and China is actually below Japan. Italy has lower bond yields than the UK, but is BBB. Credit markets think that the US credit rating will continue to fall and will continue to fall a long way. And these are the latest GDP projections for 24, 25, 26, and the United States is forecast to keep on growing, which would be good. The UK actually is forecast to have decent GDP growth in 2026. 1.2%. By our low standards, that's all right. Okay, the UK and EU announced a trade deal, which marginally improved trade barriers between the two. So the UK essentially is adopting EU food standards, which will allow farming and food exports to Europe with reduced checks at the price of allowing EU fishermen access to UK waters until 2038. We also signed a Defence and Security Pact. We are in the process of negotiating a youth experience scheme. The good news is that tourists will now be able to use the e-gates at airports. That is one of the positives. This is quite a small agreement, and EU and UK carbon markets are to be linked. So this week, I think the segments are really important. So we're going to lead with the segments, then go into market data, then go into economic data. So starting off with the One Big Beautiful Bill Act. Richard.
Thank you, Keith. So in some quarters, these are promoted as tax cuts, but of course they're not tax cuts. They are simply keeping the taxation level as it was set in 2017. And so the US budget deficit is going to be affected by the continuation of these tax cuts. So it raises federal income tax deductions for state and local taxes from $10,000 to $40,000, but it's phased out for incomes above $500,000. And child tax credit will be raised from $1,000 to $2,000, which is obviously a doubling. Bonus reduction in income taxes of $4,000 for over 65s. And tips will become exempted, or become or remain, I'm not sure, exempted from income tax.
They'll become exempted. You currently have to pay tax on them.
Right. So that's obviously good news for waiters, people working in the service sector. Cuts to Medicaid supplemental nutritional assistance program of $1 billion to help fund tax cuts. And as an aside, I think they're launching a bit of an attack on gross over expenditure in the Medicaid budget, aren't they? How successful they'll be at removing any excesses there remains to be seen. There'll be elimination of subsidized federal student loans. So students will become liable for the interest on their loans for the period that they are in study. And that's expected to increase student loan costs by 15%, which is a big hit for those in further education. And student loan debt cancellation date has been increased from 20 to 25 years to 30 years. In other words, it won't be cancelled for a longer period of time. So again, bad news for people who undertake higher education.
So bottom line, Richard, is that this will absolutely increase the deficit because, yes, you're right, it rolls over the tax cuts from 2017, but then, it raises the SALT deductions, so you pay less income tax, child tax credit increased, bonus reduction in income taxes, so you pay it over 65s will pay less in income tax, tips excluded from income tax. Basically, those are further tax cuts.
Yeah. And the cuts to Medicaid and supplemental nutrition could only become self-funding if efficiencies can be found in those programs.
Yeah, no, those are all going to be reduced in scope and in effectiveness.
So according to the Committee for Responsible Federal Budget, the One Big Beautiful Bill Act will raise the 2027 fiscal deficit by a third, i.e. from 1.7 trillion to 2.3 trillion. And that is obviously a very significant increase. So interest is about 2/3 of the deficit under current law. Under the big bill, the interest would fall to 1/2 of the deficit, whilst the deficit would increase very substantially. So this is that's after actually accounting for extra revenues from tariffs. I think the extra revenues from tariffs, it's a question of watch this space because we don't really know what they're going to be, do we? Because they fluctuate so wildly. There may be virtually nothing, or there may be significant revenues from tariffs.
Absolutely. Yeah. I mean, he keeps on, it changes literally every day. Every time we do the weekly, the tariffs have changed.
Scott Bessent must be tearing his hair out, actually, because he clearly will be trying to steer a fairly stable ship. And the person at the helm is steering in wildly gyrating course. So extending the tax cuts per this bill will cost the federal government 4.6 trillion over 10 years, and an estimate of the tariffs is they'll raise maybe 2 to 3 billion over the same period of time. So it will increase the deficit over that period of time.
Yeah, you notice how we've now got used to throwing around trillions, where it used to be billions.
Trillion is 1,000 million, isn't it?
Yeah, 1,000 billion, mate. 1,000 billion. You said 1,000 million. Freudian slip.
It's a million. US federal debt currently 36.2 trillion, and that curve is a nice little exponential. And 122% of GDP. I mean, these numbers vary, don't they? Because people include different amounts in the debt, and they she'll calculate GDP slightly. But anyway,
Well,
death percent of GDP, 122%.
no, the thing is, I was puzzled by that because I always see this 100% number,
Yeah.
and it's because actually that's the debt held by the public is 100%. The
As
Fed
in the
owns the other
Feds.
lot.
The era of funny money.
Yeah.
So this is US deficit revenue debt since 1981. And you can see that the debt level is extraordinary. So the tax cuts in 2017 and the Jobs Act primarily benefited the wealthy of the richest Americans, seeing the biggest tax cuts, 252,000 actually, top 1% was for the top 0.1%, 61,000 benefit for the top 1%. And then for the likes of ordinary people, sort of around about estimating it 2,000. This new big beautiful bill will be even more regressive, with the rich, the people in the fifth quintile benefiting enormously. And actually, the richest element will benefit by 390,000 on average.
Yeah.
So the top 4% will benefit by 390,000 on average. So very, very regressive.
Yeah, and I assume that the poor suffer because he's cutting lots of benefits, basically.
Yeah.
Medicaid, etc.
And obviously, as we've discussed, it worsens the fiscal outlook. And the path, I think the US has been on an unsustainable path for quite a few years now, hasn't it? And the path is remaining, becoming increasingly unsustainable. There's obviously this structural mismatch between spending and revenues, an unwillingness to raise taxes to pay for them. And because of its reserve currency status, the US is able to raise debt in a manner that has been able to raise debt in a manner that most other countries can't, i.e. from external parties.
Yeah.
So this is a long-term projection by the CBO that by 2050, all other things being equal, US debt to GDP would rise to above 200%. Now, I don't think all other things are equal, and I don't think that can happen. So between now and then, something has to break.
I completely agree with you, Richard. The point is that 200% is absolutely unmanageable, but it's less than in 30 years' time. And there's been a big sell-off in 30-year bonds around the world because actually people are now starting to realize, including me, that actually the US is on a totally unsustainable fiscal path, and it is showing no sign of wishing to get that in order. In fact, the opposite.
Yeah, I mean, I think they are. I think Scott Bessent is looking, and Trump, they are looking at trying to change the basis. I mean, there's this question that being the owner of the world's reserve currency gives you significant benefits and significant costs. And what Trump is doing, I think, is trying to remove the costs of being the world reserve currency by saying, Europe, you have to do your own defense. We're not going to allow the Chinese to eviscerate our industry. Whether you agree with that or not, we're not going to allow the Chinese to buy large chunks of corporate America. But then if they lose, say, world reserve currency, then there will be a significant number of disbenefits for the US, one of which is its ability to issue its debt. And my question is, and there's a lot of talk about this, isn't there, that the US is going to try and change the nature of its reserve currency status from being purely fiat currency to whether it's Bitcoin, stablecoin, or it's gold backed in some way. I don't know where this is going, but I do know that, as you say, Keith, the current status quo is unsustainable. So it has to go somewhere.
Well, Richard, on the idea that they're going to back it with gold or stablecoin, that is just like totally unmanaged, ridiculous, because they keep on increasing the deficit, and that means that it's any link to a hard asset will fail. It's like UK and the ERM, or Nixon, Golden Nixon. It's like at some stage that link will break unless they get the deficit in order. So that's just absurd.
Well, yeah, so I agree, Keith, but it's a little bit like, and I don't know the answer to this at all, but it's a bit like, well, the continuation is unsustainable. And you
Yeah.
point out that if they just go to gold back and continue to borrow at the rate they are borrowing, that's unsustainable. So what of all of the options, apart from some sort of enormous financial crash and reset, which will basically destroy the whole financial system of the world, which is not
Mm.
desirable.
Yeah.
What are their options, and what is like? It's like, what, you squeeze this hard enough, something's going to come out that's viable. What is it that's viable?
Well, the thing is, Richard, to me, they're living on borrowed time and they need to get the fiscal house in order right now because at 100% of GDP, you can do something about it. When you get to 150, you can't. And the thing about Japan, and we've got a section on Japan coming up, they're at 260% of GDP, but actually, the Bank of Japan owns 52%. I'll repeat that, 52% of all Japanese government bonds outstanding. So actually, the net debt to the public is much lower. Now, when you start thinking about the debt dynamics of when you have 130% of GDP in debt, then 1% change in the interest rate means like 1.3% of GDP in our government revenues, basically. And
Yeah,
tighten it, if you think that 30%, let's say that tax revenues are 30%, then you talk about raising taxes by 3.3% just to stabilize the situation.
yeah,
Becomes totally unmanageable.
yeah.
So they either do something now or they lose control of this. Now, in the case of Japan,
Yes.
you have, where we'll go on to Japan, you have very socially cohesive society where people buy bonds because the government tells them to. In the case of the US, that's not going to happen. And so I think bond yields have to rise to the point where actually the government starts paying attention and starts to cut the deficit. Because let's say the US goes into recession now, then the deficit, which will, after the big beautiful bill, will be about 7% of GDP when the economy is growing at 2%. If the economy goes into recession, then the deficit blows out to 10%. In 2 years of recession, you'd get a 20% increase in the debt to GDP ratio because
Yeah,
GDP would, by definition, would be falling.
yeah.
So you then totally lose control of the situation and would go because normally in a recession, bond yields come down.
Mm,
At 10% fiscal deficit, they wouldn't.
yeah, yeah. So, I mean, I think you and I completely agree on that, Keith. I mean, I think that the issue, the question really is, how does it resolve itself? I can't see. I mean, clearly, at some point, it has to resolve itself through a cut in government expenditure, but I can't see that is going to fix this problem now, because effectively they're in so deep that cutting government expenditure in any way that it is acceptable to the populace en masse is
Yeah.
impossible. So they need to do something that is different. They need a, correct my pronunciation here, is it a Dirksek Machina?
Well,
Um,
actually, if they unwound the tax cuts, they'd probably be all right.
yeah. So
But they're
I mean,
not.
maybe so. I think that, I mean, I don't know. I just know, as you do, that what is happening is unsustainable, and if it's unsustainable, it has to change. And I think the change is going to be very painful, whatever path they try to go down. I mean, there's talk about whether they revalue the land, isn't there? I see that's a bit of a, a
Yeah.
bit of a non-starter, frankly. But somehow or another, whether they whether they repudiate the debt or whether they massively inflate their way out of it, I don't know.
Well, they can't really inflate their way out of it without destroying the entire system. Because, okay, so first of all, you'd have to get rid of the Fed. Yeah. You'd have to tell the Fed that, its 2% inflation target is gone. Yeah.
Yeah,
But if you did that, long bond yields go through the roof, and which they are doing, but they would go, 7, 10%. And all US mortgages are 30-year. They're
yeah.
already at
I mean,
7%.
the
The
whole thing, the
the
whole
whole
thing
thing.
gets
Yeah.
incredibly painful, Keith. I
Yeah.
completely agree. And you can say, well, the same is true of the UK, except it's worse because we don't have the luxury of operating the world's reserve currency.
Yeah. But the difference with the UK, and we'll go on to this, but what's really caught me out is the UK bond yields follow US ones, even though the UK is actually in a much better fiscal position and it has credible policies to get its deficit down and in control.
Yes, I'm not sure how credible they are really, but
Well, we will go on to that as well, Richard. But yeah. So no, you're right. Well, I think we both agreed that this is totally unsustainable. That, previously, and we'll talk about this, well, my big disastrous position in long bonds is I thought that, well, interest rates can't go higher because the
yeah,
whole the whole debt burden becomes totally unsustainable. Therefore, they have to get
yeah.
interest rates have to come down. Well, that's
But
wrong.
actually,
Actually,
no,
it's,
because they can go higher and they can collapse the whole thing somehow.
they can exactly because what I was concentrated on the economics. I should have been looking at the politics, and the politics is nobody cares, and so they're just letting the deficit increase. And at some stage, we're going to face a crisis.
I mean, the other issue I think here, Keith, part of the problem is that all politicians have been scared to address it because it's a very painful thing to do, and they've all been kicking the can down the road. And at some point, there's a brick wall at the end of the road, and you just kick the can into the brick wall, and that's where we've got to. And it's still too painful to address it, but it will almost happen of its own accord because it's unsustainable. But it will happen in a way that is
Incredibly
pretty
painful.
uncontrollable. Yeah,
Yeah. The one thing I'd say, Richard, is I've always been incredibly impressed by the Americans' ability to fix things when they have to.
yeah,
When you think about, the great financial crisis, etc., they, deal with it, restructure the banks, etc., in a way
yeah,
that we are weaker in just, grabbing the nettle when we need to.
yeah. No, I
Um,
think that's good.
but historically, all the crises have essentially involved printing lots of money and cutting interest rates to stimulate the economy. This
Yeah,
time,
that
will they
doesn't
be
work.
willing to
Yeah,
actually endure some pain?
yeah, I agree. It doesn't work, does it? Well, it does work, but basically it just brings in massive inflation.
Yeah.
Right. Okay. So income tax rates have been much higher in the past. So the
Yeah.
highest federal marginal individual income tax rate here is in 1950s at sort of 90% plus a little bit. And currently they're at around about the high 30s.
Precisely. So, frankly, the US has got loads of fiscal space. If it wanted to get its house in order, it could.
Yeah. Yeah. Although even that is sort of, they're running that down even, aren't they, gradually? And the Trump tax cuts have not reduced personal taxes below their long-term average because there's strong capital gains receipts. And of course, capital gains receipts are a consequence of money printing. So in
Yeah.
effect, what's been happening is the Fed's been printing money, government's been printing money, they've been doing it in cahoots. That money's gone into the stock market and they've recycled quite a lot of those gains have been recycled into tax receipts. The whole thing is a giant Ponzi scheme.
So let's talk about some fiscal maths and what it would take to get the deficit under control. So the federal debt is around 120% of GDP, although only 100% of that is held by the public. So we will use the 100% number in this calculation. So assume that long-run US GDP growth is about 2.3% and US inflation is about 2.3%. That means nominal US GDP growth will be about 4.6%. So in order to stabilize the debt burden as a percentage of GDP, the fiscal deficit plus the interest rate on the debt should add to around 4.6%, basically. So in 2024, the fiscal deficit was 6.4% of GDP, and the primary deficit was estimated at 4%. So in order to be sustainable, the primary deficit plus the interest rate on the debt have to add to 4.6%. The average interest rate on the debt is currently 3.3%, but obviously bond yields are rising and interest rates are currently 4.25%, so the interest rate on the debt is rising. If we assume the average interest rate on the US debt becomes 4%, then the debt to GDP ratio of 100% would be stabilized only if the deficit was cut from 4% primary deficit to 0.6%. Okay, so you'd have to massively reduce the primary deficit. And that would mean that you would need to increase US fiscal revenues to 5.7 trillion from the current 4.9 trillion. And that would mean a 16% increase in total tax revenues. So very painful to stabilize the debt now, but not impossible.
I think that's the point, isn't it? Very painful, and politicians don't do very painful.
Yeah, well, there's the bottom line is this is all academic because they're not going to do it.
No. So thank you for that summary, Keith. Very interesting. And so situation isn't irreversible, but the reversal would be extremely painful. So immediate action could cut the primary deficit towards 1%, which would bring interest rates down and start to stabilize the US debt to GDP ratio. But if the Big Beautiful Bill Act passes, which I'm pretty certain it will, then US public debt will have risen to around 100% of GDP by the time he leaves office, Trump leaves office, and stabilizing the situation will become much more drastic. Action, tax cuts, tax rises, spending cuts. But, the whole thing, as we say, is academic because our politicians, or these, in this case, it's their politicians, are highly unlikely to take these actions that will cause such intense pain. And
yeah.
So they're going to carry on going down this. The danger is they just carry on going down this route, all of them collectively, until the thing does actually break.
Yeah. Now, I was listening to the Rest is Politics US podcast, and they were making the point that Donald Trump has done nothing about which has long-term effects. Everything he does is concentrated on the short term. He doesn't care about the long term. What he must do.
I don't agree with that. I mean, a lot of it is short term, but he's switching, making a lot of changes to nuclear fuel, nuclear energy in the US. That's undoubtedly long term, and he's also making changes to the production of rare earths in the US as opposed to Chinese being dependent on the Chinese for rare earths. So I think he is doing some long-term stuff, but a lot of what he's doing at the moment is it's short-term chaos, isn't it? And I think that's why it appears that he's doing nothing for the long term. Yeah. And I'm not disputing that all of this stuff that's going on with tariffs and everything is all, it's incredibly short-term in the way, in the actions that are being taken. There's some long-term objective, but it's hard to know really what it is. So what are the possible outcomes? Well, first is that there's no problem and markets continue to ignore fiscal sustainability. Well, I don't think that's very likely. I think the markets are pretty spooked. And I also think that overseas foreign countries are not keen on buying US treasuries anymore. And that removes a big buyer from the marketplace.
So, Richard, on that point, cutting the trade deficit means that you're giving fewer dollars to foreign entities and you
Yeah.
remove it, you're reducing a natural buyer of US treasuries.
Yeah. Yeah. I mean, the whole thing is completely mixed up, isn't it? So messy. So US can have to cut the deficit. Growth slows, inflation falls, interest rates fall. But as Keith says, actually also the overseas purchases of US debt has to drop. Trump ignores the deficit, financial repression, forcing financial institutions to hold more bonds. But all of these are short-term fixes to the fundamental problem. And then finally, a crisis, it all basically blows up.
Yeah.
Bit of a mess.
Yeah.
Yeah. So these are our prognoses. Well, you've got mine pretty right there, Keith. I mean,
Yeah,
I hope there isn't a. Go on.
so before, I was, skeptical, frankly. But I thought everyone's always predicting the end of the world, frankly. Debt levels have been rising for a very long time, and why should there be a crisis now? The system will always protect itself. And the system is only sustainable if interest rates fall back towards R star and below. And with these rising debt burdens are only sustainable at very low interest rates. Hence, I was expecting interest rates to fall. Yeah. But that hasn't happened. It's good the opposite has happened. Actually, Richard is absolutely right. Markets are spooked. And that means interest rates are rising, which makes the whole thing unsustainable.
There's another factor at play here, I think, Keith, which is the laudable, I think, efforts by the US to use sanctions to try and stop Russia and to stop Iran developing nuclear weapons has backfired in the sense of it's removed confidence of countries other than the US in holding US assets, because they realize that the US has now developed a system of confiscation, which it can apply at any point that it chooses to do so. So as well as all of the domestic issues, they've got the issue of the loss of confidence in the US as an honest, I use the word with little h, an honest broker in the financial world.
Yeah, no, I agree. But I mean, I think where we differ is I'm not expecting an end to the global financial system. I'm expecting
not expecting an end to the global financial system, but I am expecting some sort of fairly significant change to it.
Well, I'm expecting that markets will force a change in direction. And if they don't, actually, well, when bond yields start rising to the point that this is a serious problem for businesses and consumers, then I think there will have to be a change in direction. But basically, any change goes through a crisis. Full stop.
I agree. The crisis has to happen.
Yeah.
In order to force the hands of the politicians. Yeah. So investment implications. The sense is that yields keep on rising. So the bond bear market continues. I'm not sure about inflation remaining quiescent, but that's a separate issue.
Yeah. But my point there is, Richard, that bond yields are rising even though inflation in the US has been going nowhere. It's been coming down.
Yeah.
Which is, I expected bond yields to come down. They didn't.
Yeah, the driver for bond yields rising is not inflation. It's discomfort with the stability of the system. Equities struggle. Obviously, equities will struggle with bonds up, bond yields rise, and equity valuation should therefore begin to fall, with the caveat that if the Fed continues to print money and that money finds its way into the stock market, equity valuations will not fall. They will continue to rise. And I think, because there's a strong correlation between money supply and the US equity market. So
Yeah.
that would be my caveat there.
Okay.
And gold and other safe havens rise. I completely agree with that.
Well, the trouble with gold is that, when you look at what happened in, say, the 1930s, I mean, gold is um, is a financial asset, but as part of the solution to the crisis, the government may seize citizens' gold holdings, which is what they did in the 30s.
Yeah, which is what effectively money printing is.
Yeah.
It's seizing fiat currency holdings via inflation. What a mess, Keith.
Yeah. So the bottom line is that gold is rising and treasuries are not acting as a safe haven anymore. So the market is worried, and the fiscal dynamics are such that, unless the US gets its house in order, then we are heading towards some sort of crisis. But that is not going to happen this week, next week, this year even, but it will happen in a few years' time.
It's a
And
slow burn at the moment.
slow burn. But these things always accelerate
Yeah.
to disaster.
Yeah.
Now, the flip side of that discussion is that actually, when we've been concentrating on, the fiscal effects of the big, beautiful bill, but when you compare it not with what would happen if they didn't pass the bill, but assume that the change compared to now, i.e., assume that the pre-existing tax cuts will be rolled over. What is the incremental effect of the new bill? Well, actually, with tariffs, it doesn't really raise the deficit that much, apparently. The problem is the existing status quo is totally unsustainable. Okay, and now a big mea culpa from me. So, all of you will know that I have had a terrible time with my big position in UK long-dated gilts. Now, last week I was on holiday in Scotland and sat on the beach in Iona contemplating my terrible performance, and I was thinking, I've stuck. I'm very good at discipline and I'm very good at sticking to my plan. But I sat on the beach thinking, this plan isn't working. What would George Soros do? And actually, what George Soros would do is he would get out entirely and he would go move to cash and then he'd think about what to do next. And I realized my plan was a very bad plan. That rather than sitting, waiting for things to go my way, which is essentially passive, I should be active. And so get out, wait for things to actually go my way, and then, if I so choose, get back in. And so that is what I'm going to do. Now, I'm not going to disguise how bad this trade has been. It's been a total disaster. So looking at one of the long dated gilts that I bought, although I don't hold it now, viewers who've saw my piece on why index linked gilts in the UK are uninvestable because of the move to CPIH in 2030 will remember that I got out of it earlier in this year. But this gives you an idea of my trade and how badly it's gone. So in 2022, T68, the 2068 index linked gilt, peaked at a value of £340. Now, when it got to 100, this is Liz Truss's moment when UK gilts collapsed. When they bounced back, I thought, okay, that's it. We've seen the worst. This sell-off, gilts will now recover to, I was expecting 150. So I was expecting that yields would fall. In fact, they continue to rise, and the price is currently now £45, and I've held it for most of that period. So I've lost a lot of money. Now, what happened last week to crystallize my movement, my decision basically to get out, was three things that made it look like that the rise in yields was going to continue. For a start, as we've discussed, the One Big Beautiful Bill Act passed the House and is headed to the Senate, and that will increase the US fiscal deficit. UK inflation came in hot, and it now looks like that inflation in the UK, if it will come down, it's not going to come down towards the 2% target until 2027. But in particular, the Labour government agreed 3.5% pay rises for the public sector. That was up on early discussions of 2.8%. And everywhere, it's becoming clear cutting benefits is difficult. It's proving impossible to reduce welfare spending, which means the fiscal deficit in the UK is going to prove difficult to rein in. All of that is inflationary. Now, the
I,
bottom line
sorry,
is
Keith,
all. Go on.
can I just add something there?
Yeah.
Which I think is your point about cutting welfare benefits is so well made. I mean, the current government tried to cut welfare benefits, has failed. Labour MPs are sort of saying that rather than cutting sickness benefits, they should be increased. Nigel Farage, bless his cotton socks, has come in and said that he will remove the child benefit cap. I mean, our politicians are still living in some Alice in Wonderland world where money is free.
Yeah. And honestly, Richard, I think we are in a new era, which I'd failed to fully realize, where I think the influence of social media, people are calculating with their emotions rather than with their heads.
Yeah.
And so I really think it's going to be very difficult to cut welfare benefits. Now, I was listening to Radio 4 and actually a comedy program, the news quiz on Radio 4, four comedians, and I was struck by how Jacobin they all were. So they were talking about the welfare, and then they went on to discuss how they should basically scalp the rich. You know, we've lost 11,000 millionaires last year. Their attitude was get rid of them. Who needs them? Billionaires, scalp them. You know, who cares about? We don't want billionaires in this country. Essentially, they're saying that, tax the rich to pay for welfare benefits. Now, that's very bad for UK growth. You're talking about further big increases in tax. Now, the trouble is that Rachel Reeves has ruled out raising income taxes. And what's she going to do to balance the books? She's going to have to break some of her promises. Either she breaks the promise to the markets about fiscal sustainability, or she breaks it to the electorate about raising taxes. Something's got to give. Coming up is the October budget, and previously she has not proved competent. The last budget was a disaster for UK long-dated bonds, basically, which again I failed to react to, and I'm not willing to do the same again. I'm going to wait and see at least what she does. Now, eventually, I still believe that if the system holds and we have some sort of fiscal responsibility in this country, then long-dated gilts will fall back towards 3.5%. And at current levels, they offer really good value, particularly if tax rates rise and you can get, because UK gilts, the capital gain is tax-free, they offer unbeatable value compared to getting interest in a bank, for example. But that presupposes that yields don't keep on rising, which is currently they are. I mean, one of the reasons I stuck with the trade is that, when you look at the yield you're getting, I mean, on the long dated gilts, I was getting the equivalent of 8%. Like, so although I was getting nominally 5%, because most of that was coming as capital gains, if you hold it to maturity, you get 8% equivalent. You'd have to get 8% in a bank to meet the same. But as I was sat there on the beach in Iona, I realized I wasn't getting 8%. What I was getting was losses every day because the yields were rising. And I'd only get 8% if I held it to maturity. And it was much better to get out and get back in and curb the losses. Now, okay, going back to the start of this disastrous trade, what was my thesis? Well, my thesis was that long-term interest rates are a function of inflation and economic growth. The Bank of England has 2% mandate. Eventually, inflation will return towards 2%. I still believe that. Economic growth in the UK remains anemic, let's say 1%. Therefore, long-term interest rates should be around 3%, 3.5%. And in a recession, and this was a cyclical trade, they would be cut well below that. And I would make a lot of money, is the idea. And I thought that the rapid rise in interest rates on both sides of the Atlantic would cause the economy to slow. All the leading indicators at that time were showing a forecasting recession. As the world economy went back into recession, central banks would cut interest rates, and as the cycle turned down, that bonds would do well. And previously, one of the reasons this trade has been such a total disaster is I played the cycle. So when you I've tended to buy equities like oil put equities in particular at bottom of recession, and then you never get the timing quite right, and you just wait and for the cycle to turn, and then they go through the roof. And so I had an incredibly good pandemic where I made 70%. Great. You never get the timing quite right, but when it paid off incredibly well. So this was a cyclical trade. And in a cyclical trade, you absorb the losses and you wait for the cycle to turn. And it's just a question of discipline. And I'm good at that. So I just sat, as the losses mounted, I just accepted them and absorbed them. But what if the rise is not cyclical, but secular? Now, the fundamental problem with this whole trade was sizing. I came out of the pandemic thinking that I'd cracked this game, frankly. I'd made a lot of money, just play the cycle. I massively oversized this position, and then I stuck with it. That's it. Lesson learned. Never doing that again. And having oversized the position, I then got stuck. And my plan was to stick with it, and I stuck with it. And I stuck with it despite everything going against me. Number one, the US economy did not go into recession. Biden increased the deficit, and the US economy continued to tick along just fine. Action, I should have accepted I was wrong, cut the position. I didn't. I stuck with it. Two, the politics went relentlessly against me. All my argument was based on the economics. What I didn't realize or didn't take account of is the politics had changed. The pandemic had meant that fiscal deficits around the world had massively increased, and governments around the world showed little sign of actually trying to get them under control. I mean, Liz Truss was going to massively increase the budget deficit in the US. Trump is doing exactly the same. There is very little appetite for fiscal discipline anywhere. Now, previously, I assumed that didn't matter. Well, actually, the market is saying it does. Again, Trade went against me. Should have cut the position. I didn't. The market went against me. This is it. You listen to the market. Markets became concerned about the UK fiscal position. Bond yields rose relentlessly. I should have cut the position, moved to cash. I didn't. I'm doing it now. Wait for the markets to move in your favor, then put the position back on. That is a much better strategy than just passively sitting it out. So be active. Net result, total catastrophe. I lost 30%, cut the position potentially at the bottom. Actually, I don't think it is. I think it'll get worse. But it's difficult to see how I could have played this much worse. The
But
good
can I
thing
just
is,
chip in?
I finally made a decision. I've finally done it. I can afford these losses. I can't afford to do it again.
So, well, first of all, well done for going through this in such detail and that thought process, Keith, because it's really important to understand those things in one's own investing, and also it helps to understand the mistakes other people tell you about. I was playing for a secular change, which was
Yeah.
gold. And there were times when I had quite substantial losses in my position. Not so much in gold itself, but in the shares, the mining shares, which I have. And I stuck with it because I believe that my understanding of what was going on with the secular changes was correct. But it's very, very difficult. And, you know, that for me, that is beginning to pay off because I have these positions, although not actually in the way that I expected it to, not as quickly as I expected it to. And I just think that, you know, one can beat oneself up endlessly about these things, but a 30% loss, I've sat on those and
Yeah.
sat on them,
So have I.
and they've reversed, you know. So I know it's a lot, but it's, you know, it's not unconscionable. And I mean, I happen to believe that your analysis is correct in terms of government debt.
Well, the thing is,
All that,
Richard,
all
I
that.
still think that, medium term, I still think I'm going to be right. I'm like, I still think either the system is going to blow up, and I don't think that's true, or the markets will force fiscal discipline, in which case bonds are great.
And
But
if you are right, Keith, then you may well be right from a much higher interest rate.
precisely, that's right. Rather than just passively sit through it, yeah, wait for the market to, buy at the bottom. Basically, I've always made my money by buying in a crisis. Well, this time the crisis is going to be bonds. Wait until they actually, everything accelerates to crisis point. Wait for
Yeah.
that point. Actually be disciplined again in just sitting and waiting. So anyway, so fundamental problems with this trade. Just number one was overconfidence. I thought I was a genius at this thing. And now I've spent 3 years of basically being totally wrong and having to admit to everyone on the podcast I was losing money when you were all making money. And I was just, I'm good at sticking to my thesis. But my thesis was wrong and my strategy was wrong. And in future, big lesson learned, don't be passive. Actually, just be active. And the biggest frustration was I was out of the market, and there's lots of things actually I probably wanted to buy, but I was just like, no, I've got my strategy, discipline, stick with the strategy. It was a shit strategy. So in future, don't oversize positions. I'm not doing that again. Full stop. I can't afford to do it again. I'm not doing it again. Be dynamic and don't get trapped in position. I've lots of people on the Discord and friends of mine just said, just cut, get out. And I said, no, I have my strategy. I'm sticking to it. And as a result, I've kind of finally realized everyone else is right after terrible losses. But these secular changes, don't happen very often. And I think my cyclical approach can work, will normally work, but
Mm.
I have to be aware that secular changes do occur. So, but I did get a few things right. Number one, no gearing. So the losses are bad. They could have been, previously I've had gearing. Watch some of my worst trade videos. You know, I've had gearing before. Disaster. Never do it. I was not forced out of this position. And rising bond yields. Now, I can't emphasize this enough. If the system holds, then bonds are just, I think they're unbeatable. You can basically now buy UK government bonds and get an income, a real income after tax, after inflation of 2%. Now, if you try and do that by getting interest in the bank, you'd have to get 7 or 8%. So, you can give up and just buy UK gilts. And frankly, at some stage, I will absolutely be buying gilts. Um, and now when it comes to being ready to admit you're wrong and prepared to take your losses, which, I've been very happy to admit I'm wrong. I've come on this podcast basically every week for the last 3 years and said that I'm wrong. But what I wasn't willing to do was admit to myself my strategy was wrong and just take my losses and get out and, be prepared to be more dynamic. The sooner you cut your positions when you're wrong, the richer you'll be. Lesson learned.
Mm.
So bottom line, I'm looking at the UK 10-year, and previously we talked about buying the TG51, which is 25-year, and playing it as yields come down the yield curve. I'm very much looking at that trade. But we are in a bond sell-off I see no reason why it shouldn't continue. Basically, all the catalysts in the short term are bad. UK inflation is back above 3% and will continue to rise in the coming months. US inflation is rising again. Trueflation in the US, we'll take you through the numbers in due course, is rising. The big beautiful bill will pass. I have no doubt about that. And it will raise the deficit, and the bond vigilantes won't like it. The UK fiscal position is deteriorating. Now, previously, the UK budgets have been a bit of a disaster for UK bondholders. And I'm not holding this position through the October budget, full stop. The big danger for Rachel Reeves is UK productivity is awful. The OBR, which sets the fiscal outlook, had previously been quite optimistic about UK productivity. If they were to downgrade UK productivity forecasts, then the projected fiscal balance gets much worse, and she will then be forced to raise taxes or cut spending further.
So I was reading an interesting paper yesterday by research affiliates, and they looked at I think over the last 50 years they've looked at productivity in a number of countries versus the size of the public sector, and basically the sweet spot for the size of the government is between 20 to 30% of GDP. Below that, you don't have the rule of law, you don't have stability, and above that, it starts to put a big drag on UK productivity, And clearly, we've got a big drag on productivity at the moment. And the problem we have here is that the UK government is getting proportionately bigger, not smaller.
It is.
And this productivity issue will not be addressed until the UK government becomes smaller. And the way I see it is the UK government won't become smaller unless there's a crisis.
Well, the way I see it, Richard, is the UK government won't become smaller, and markets will enforce fiscal discipline, which means tax rates will rise, which will kill growth, which means that interest rates have to come down. But that presupposes fiscal discipline, and fiscal discipline will be enforced by the markets. Now, and that may well mean that bond yields stay constantly higher than they have been in order to enforce constant fiscal discipline.
So I agree, but my sense is that we're going to be seeing interest rates of 10 to 15% before that
Right.
sea change occurs. I don't think we're anywhere close to the top of the interest rate cycle. I don't think we're anywhere close to it. I think we have a
Right.
long way to go before basically the enforcement will be, because the system is broken, the system will be broken because interest rates will be so high. And I
Well,
remember, when I started my career, when I was first, I've probably said, if I said this before on this channel, but when I first started as a finance director in the care business in the late 1990s, we had fixed rate loans at 15%.
yeah, but then inflation was much higher, Richard. Inflation is
It
nowhere
was,
near that high.
yeah, but you see, there's this. Well, there's a there's a I think there's an if then fallacy here, and if inflation is low, interest rates are low. I think that's a fallacy. I
Mm,
think it's more complicated than that,
that's true.
and
Well,
and
it is.
that the yeah, and that the problem we have is that the system has been pushed to breaking point, or is being pushed to breaking point, and therefore those correlations are breaking down and will continue to break down. And actually, what will cause a reset is when the correlations have completely broken down and the whole thing becomes unmanageable. And that's
Yeah,
where I think we're heading. Well, I just think the danger is, it's a really dangerous thing to do, which is to look at the old correlations.
yeah.
Because I think we've moved, I think we've, there's a discontinuity, if you like.
Well, you've been right, and I've been terribly wrong. Now, medium term, I still think the bonds, for all the reasons I've outlined, are potentially a very good investment, but you have to wait for fiscal discipline to be imposed. Because our
So
stock, if you
I was just,
go
bonds were a very good investment in the early 2000s up until 2022 or wherever,
yeah,
And so they were a very good investment for approximately 20 years because the yield was constantly falling. I think that this the cycle that you're looking at will begin when bond yields go back up to, as I've said, 10 or 15%.
precisely, Richard. That's exactly right. So, that's what I'm waiting for.
Yeah.
But Um, the thing is, you're right, the bond bull market lasted 20 years, but this sell-off will accelerate. Because the thing is, the dynamics of, as bond yields rise, the fiscal position massively worsens. So, I can see that if this continues, you're going to have to get to a crisis point, and then will depend how governments react. But
Yeah.
yeah, it's not looking good currently. So what am I going to do now? Well, I'm not going to rush to do anything, frankly. I'm going to sit and think about things for a few days, few weeks. There are a few REITs that I want to buy, but I'll buy a bit of gold. But I'm probably going to remain largely in cash. I don't like equities. I just don't think that they've done incredibly well, but we're in an incredibly volatile situation, and they're very highly valued. I mean, that to me looks like taking risk. I don't want to take excessive risk. I've taken excessive risk. I'm going to now be focused on capital preservation, which you can get from short-dated gilts. So I'm going to be trying to do that while avoiding trying to get any income at all costs, because income is going to be taxed. You want to buy short-dated index-linked gilts if you want to move to cash. Moving to cash does not mean holding cash. It means holding inflation-linked securities. And I will be actually more active in reporting what the hell I'm doing, basically, every couple of weeks. I've been trapped for 3 years, and it's been a total disaster. So, yeah. Anyway, let's move on.
Well done, Keith, for reaching that decision.
Yeah. So, I mean, the point is, and you can all, you'll have your own opinions on this as I've been reporting this over the last few years, but you have to retain your self-confidence. You mustn't let triumph and disaster influence you too much. Frankly, I let triumph influence me too much because I thought I was, good at this game. Last couple of years, been a big blow.
I mean, the other point I'd like to make is probably my last point really is that I think the central planners, central bankers, and so forth, they've got this narrative, which is the 2% inflation targeting, R-star, which you
Yeah.
mentioned, all these things which sort of say, we're in complete control of the system. It's very stable. Nothing can go wrong. We can fix any minor hiccups on the road. I just think it's wrong. And so I think fundamentally they have grossly oversimplified what's going on, and that if they really believe what they say, it is going to fall apart. And if they don't believe what they say, then they don't believe it, and they'll be doing things behind the scenes. But I think it's very dangerous to take the narrative and the sort of economic dogma at face value, because we're in such uncharted territory.
Yeah, well, we do this, but this podcast is set up because, the economics matters. And actually the markets matter. Listen to the markets rather than to the economic data is that one of the takeaways from this, actually.
Yeah. And those who have an interest, I mean, central banks have an overt self-interest in talking everything down, but what they say may well not be true. And it's not easy. It's trying to understand when they are simply trying to tell everybody that things are okay when they're not. And I think currently we're in a situation where they're not okay, and we're being told that they are.
Okay. Related topic, the UK budget, Richard.
Well, it's a disaster, isn't it? I mean, and it has been. This is not Keir Starmer's fault. I mean, I just want to. This is apolitical. Well, it's not apolitical, but it's a political with a small p. In that this is a problem that has been in the making since John Major became Prime Minister, in my view. And Margaret Thatcher did a lot of things that she shouldn't have done in terms of massacring our industrial base. But these issues, actually, I suppose it was, in some sense, it was a big bang, wasn't it? Which was under Thatcher, I believe, Thatcher and Reagan. Okay, so that's a very long history to it. The National Institute of Economic and Social Research does not think the Chancellor is on track to meet her fiscal rules. I'm sure they're right.
Well, look at 2025.
I mean, the difference between the OBR, which is supposedly independent, and the NIESR is enormous.
Yeah. It's that is super bad. If they are even close to right, that's super bad.
I mean, one of the points I think that is completely missed is that GDP, to my mind, GDP is something that, well, it can fluctuate. It can fluctuate month on month for good reason. It can fluctuate, but it's sort of reported as a degree of certainty, like GDP growth last month was 0.2%. Well, maybe it was plus, but I suspect it's 0.2% plus or minus 0.5%. And I think that we are, GDP growth is so marginal that to place any faith in GDP forecasts actually is foolish.
Yeah.
Particularly when you have politicians continually meddling with the system, meddling with employment laws, meddling with tax rates. And I'm much more inclined to go with the NIESR forecast.
Well, I saw this. This is frightening. Honestly,
Yeah.
this is really frightening. There's the OBR is forecasting 1.3. The NIESR is forecasting 4.3.
Yeah.
That's not funny.
So Reeve's fiscal buffer, well, it's tiny, isn't it? It's almost sort of irrelevant. Um,
And that's
and
based on this
yeah,
forecast.
yeah. Okay, so I mean, let's assume the NIESR forecasts are correct. I mean, that is going to push UK gilt rates up to 10% or whatever.
Yeah.
Um, those deficits, and the A word, austerity, which is really basically stopping government excesses. And that's the sort of
Well,
thing that will reduce the government size as a percentage of GDP. Ultimately, it'll be forced to happen.
well,
But
the
it's
thing is
critical.
austerity, Richard. Austerity was essentially cutting, keeping a lid on welfare payments and government spending. I think the government's going to go the other way and they're going to massively increase taxes.
Yeah, they will, but ultimately that'll blow the economy up.
Yeah, exactly.
I mean, the problem is not the winter fuel payment. The problem is that we have um, far too much expenditure by the welfare state.
Well, the winter fuel debate is just ludicrous. It's means tested. So the idea is, you're taking the winter fuel payment away from people who can afford to pay for their own fuel. But again, this is a very good example to me of how the gerontocracy works. Old people voting for sweeties for old people at the expense of working people.
Okay, so UK productivity, which is basically fallen, is now on a downward trend. It was on a bit of an upward trend before COVID, but
Actually, can I come in there, Richard? I don't think it is
yeah.
on a falling trend. I think what happened was there was a massive boost in productivity during the pandemic, which is proving now to be unwind, basically. So I think if you just kind of draw this kind of slowly declining
Yeah.
trend, I think, I don't think it's going to keep on going down. I just don't think it's going to go anywhere. And the thing is,
I
the
mean, the problem
LPR is forecasting that UK productivity will recover.
it won't recover because the size of government is too big, and the size of government is forcing productivity down because government is notoriously unproductive.
Good point.
So productivity will only go up if government gets smaller. In essence, UK fiscal deficit uh, minus 3.6%. PSBR rose in April despite tax increases, and the government's not on track to meet its rules. So what are the outcomes? Tax rises in the autumn budget, relaxation of fiscal rules, i.e. fudging it, and crisis, or maybe all three
Yeah,
in some
no,
order.
absolutely. I'm kind of expecting a combination of all three.
Yeah. Yeah.
Thank you, Richard. Okay, quickly on to Japan.
What I don't get about Japan is this concept that because the debt is all owned domestically, or most of it's owned domestically and or by the central bank, that there isn't an issue. My point should be that there's an enormous issue because there is so much debt. It doesn't matter
Mm.
who owns it. So that's, as you go through this, can you talk about that a bit? Because I don't really get why it's
Okay,
thought
well,
to be not an issue.
let's talk about that now because the thing is,
Do
the
you want
debt
to
is the debt is owned by is owned by the central bank, which is an arm of government. So, all the interest rate payments, etc., go back to government essentially via the central bank. Now, what that has all meant is that cash has been pumped into the Japanese economy, which has been saved. Yeah. So it hasn't caused a rise in inflation.
Right.
But so in effect, you've got just the Japanese are just sitting on massive amounts of savings. Now, if inflation were to pick up, the danger is that they all think actually this cash, which had, when inflation is 0.5%, you can sit on cash in your deposit account, which is getting nothing and not care very much. When
Yeah.
inflation is 3.5%, suddenly you have a big problem because if you're getting like
Absolutely.
nothing in your bank account, you think, well, I better go and spend this before its value is totally eroded. And then you can precipitate a massive increase in inflation.
So basically, it's all the money printing has gone into cold storage,
Yes,
and if it comes out of cold storage,
yes,
then things get really ugly very quickly.
yep, that's exactly right.
That's
But
very
it's
helpful. Thank you.
but it's a very stable, socially stable country.
Yeah.
That said, so was Germany. Weimar no, is not a very good example, but you can actually these things precipitate themselves very quickly, you know,
Yeah.
in a matter
Yeah.
of months. So, talking about Japan, so inflation in April was 0.1%, which is fine, but 3.6% year on year. Core inflation 3.5% and rising. That's not funny. And the as we've talked about in previous weeklies, the latest wage settlements in Japan have been inflationary, as though wage inflation is becoming embedded. Now, and that is all despite GDP actually shrinking in Q1. So you've got absolute stagflation in Japan. Japanese interest rates are 0.5%. Now notice that 0.5% when CPI is at 3.5%. You've got minus 3% real yields, interest rates. So 1 month bond, which is tied to interest rates, 0.4%. The 1 year is around 0.5%, which is interest rates 0.5%, but see how they've risen. The 5 year, the Bank of Japan is losing control, up 1% and rising. The 10 year, 1.5%. The 40 year, 3.3%. So the market is losing confidence in the long-term fiscal sustainability of Japan. And that's despite the Bank of Japan owning half of the bond market. Amazing. So what they do, reminder QT, the Bank of Japan buys bonds from the banks and it stuffs the banks with money. And the banks hold, if they're not lending it out, that sits on their balance sheets. So essentially what's happened is you've just had an asset swap. The banks, instead of holding government bonds, they're now holding cash. Now, the Bank of Japan has the ability to raise interest rates to curb inflation, but they're just not doing it. And rising bond yields are the function of the credibility of the Bank of Japan's inflation fighting credentials. And essentially, markets are losing confidence in the Bank of Japan. It could restore its credentials by increasing interest rates, but there seems very little sign that it's going to have positive real interest rates. You'd have to go from 0.5% to about 4%. Now, the recent Japanese bond market, which caused the big sell-off, still had a bid to coverage ratio of 2.5 times. The market thought that was low, but it was still well covered. Let's contrast that with the Greek debt crisis, when the government essentially halted auctions because it couldn't sell any bonds. So this is not, let's not get carried away by thinking this is an immediate catastrophe. There are still bids for Japanese long bonds. So it's not yet a crisis. Bond yields are normalizing after years of repression. The Bank of Japan is selling its bond portfolio. In March, it sold 120 billion, although in the 3 months to March, it only sold 125 billion. So it's not selling 120 billion a month. Um, where does this end? I'm not sure. Bond yields are rising because of rising inflation and QT, but the auctions remain well covered. How high can bond yields rise? Don't know. Let's just wait and see.
Hmm.
Okay, so we're going to try and get through the rest of this quite quickly, and normal service will resume next week. Okay, Richard, equities.
That's Keith. Thank you, Keith. Okay, so the weekly change is actually a 2 weekly change, I think, isn't it,
Yeah.
Keith? So the FTSE All World up 4% over the last 2 weeks, the year to date up 5%, and the All Share 2.6% and 6.6%. The stocks 600 doing very well, up 2.6% and 9.3% for the year. The S&P is only up 0.7% for the year, but it is up for the year
Yes.
despite the sort of Trump tariff tantrum. Russell 2000, however, is down 6% on the year, but it was up 3% for the 2 weeks. NASDAQ is not pretty much unchanged for the year, actually, but up 7% in the 2 weeks. Hang Seng is up 16% year to date, almost unchanged for the 2 weeks. Topics pretty much unchanged. Bitcoin up 18% on the year and 5% in the 2 weeks. The pound is now up 7.8% for the year, and that defrays the rise in the price of gold, of course, because gold is priced in dollars, and in fact defrays the same for any commodity. So from my point of view, that's not good news. And the euro is up 9.3% for the year against the dollar index down 8% year to date and down 1% nearly last week. And the VIX fell right back and is now at 8.6% for the year to date.
So equities are not pricing in any sort of crisis at all. Equities think that it's back to normal. I don't think it is back to normal.
I don't think so either.
But I mean, the buy the dip in equities has absolutely been the right thing to do. Yeah.
It has, but personally, I could never pull that trigger.
Yeah, well, I can, but not, it has to be when things have got really bad. And
Yeah,
I
no,
think
well,
that the US
definitely.
is still overvalued.
So there's the FTSE All World Equity Index.
Yeah, again, it's like the Trump tariffs and, all the chaos never happened. I think it did
Yeah,
happen, and it has an effect on corporate earnings.
yeah. And has there been damage beneath the surface? There's FTSE All Share looking pretty much the same. The Euro Stock 600 looking pretty much the same. The S&P 500 looking almost the same. And NASDAQ looking like the same.
Getting back towards all-time highs, both of them. This is
Yeah.
interesting.
So the Russell 2000, the smaller US companies, is not doing so well.
Yeah, this is the great mass of corporate America.
So Hang Seng, with all these charts basically are the same chart, aren't they, Keith?
Well,
The topics, Bitcoin being boosted by Trump, pound against the US dollar, which has been rising steadily since January. Euro against the dollar been doing the same, but a bit more of a noisy chart. And the dollar index, which has fallen below the 100 level.
yeah, these are big moves in the currency market, actually.
Yeah, and there's the VIX, a big spike that has now gone away. So S&P 500 earnings guidance is slowing.
Yeah, you see, this, equity markets are doing well, but actually, when you talk about underlying earnings, they're not doing so great.
No, CEO confidence collapsing, which is interesting. Put call ratio suggesting that investors are nervous.
Yeah, lots of people buying
Again,
puts.
yeah, and the smart money is short the market. The hedge fund added 25 billion of short equity futures, so the hedge fund's definitely very short. And the retail buyer is jumping in with both feet. Growth continuing to outperform value. and small caps continuing to underperform the S&P 500.
And that suggests a weak underlying economy. You know, strengthening economy, small caps outperform.
So US semiconductors had a bit of a glitch in their meteoric rise. Where will it go from here? Is that half of a head and shoulders?
Yeah, I've been saying it is for a while. I stick to that.
Yes. Quantum, D-Wave Quantum Inc. I mean, quantum computing, yeah, I think it probably is the next fad. I think it's incredibly difficult to get these things to work.
I'll believe it when I see it.
Yeah. And Bitcoin is now, oh gosh, the 8th largest currency in the world. Well, look at that. 2 trillion. And the 5th largest asset. And it's becoming America's reserve asset. I just have to say the John Paulson quote of Bitcoin is a limited supply of nothing at this point.
Yeah. Okay, thank you, Richard. On to commodities and quick summary. Energy markets, oil's flat, nat gas recovered sadly. Uranium, maybe the bull market's back on, Richard. Uranium showing sign of life. Industrial
Fingers
metals,
crossed.
sorry.
Fingers
Industrial,
crossed.
yeah. Industrial metals were mixed. Aluminium was up, nickel's down. Precious metals continued strong, particularly platinum. So onto energy. So Brent, oil prices were volatile, but they ended the last couple of weeks down. European natural gas futures sadly rose 6.4% on the over the past couple of weeks. You'll be aware that the off-gen price cap in the UK for July is falling by about 1%, while rising gas prices are not good. US natural gas futures fell by 8.8% over the past couple of weeks, and that takes them down on the year. Coal is up 2%, but still down 20% on the year. Uranium showing signs of life, though still down on the year. This is Brent. Whereas OPEC is adding, what, 400,000 barrels a month for the rest of this year. It's going to be difficult to see how oil is going to go anywhere. WTI, same. And there were inventory builds in the US. So the US is oversupplied. Now, US shale oil production is forecast to peak in 2027. And the falling oil prices mean that rigs are coming out of the market, and that means that the latest forecast is that US oil production will fall by about 300,000 barrels a day this year. Of course, that's going to be dwarfed by OPEC increasing production by 2.1 million barrels. So there's very little prospect of rising oil prices this year. The rise in OPEC plus oil production over the next year has only just begun. So the chart you're looking at is the left here, had some increase in production. It's going to get much bigger. EU natural gas futures sadly off their lows, same for the UK. US natural gas futures down in the past couple of weeks, down on the year. Coal seems to have bottomed. All the commentary I read is that the coal market is oversupplied. Uranium, well off its lows. On to industrial metals, Richard.
So aluminium, I'll just go through the year to date, I think, really.
Yeah.
The aluminium was down 2.3% for the year to date. Cobalt was up nearly 40% year to date. The copper actually up 18% year to date. Iron ore down 4%. Lithium down 18%. Neodymium up 8%. Nickel almost unchanged. Tin up nearly 13%. And zinc down 10%. So the big movements there are cobalt, copper, and tin. Big positive movements.
I think the copper price is exaggerated by the stockpiling in the US, basically.
Yeah, I'm sure that's right. There's aluminium, cobalt, copper, iron ore, lithium, neodymium, nickel, tin, zinc. Precious metals. So again, year to date, gold is up 26%, silver 15%, platinum 21%, rhodium 17%, palladium 10%. So platinum, rhodium, palladium are playing a bit of catch up with gold and silver now. And platinum was up 9% over the last 2 weeks, which is a big move. So platinum group metals all on the up. Gold chart there. And gold is set for a record $85 billion of inflows into funds in 2025, which is much larger than any previous years. Silver, platinum, rhodium, palladium.
Okay, thank you, Richard. On to rates. So this is the shape of the UK yield curve, and it's not good. So UK interest rates currently at 4.25%. The 1 year is like 3.9%. So the market's still expecting the Bank of England to be able to cut rates over the course of the coming year. But it's charging an enormous premium to lend to the UK government over 30 years. And that is not anchored to interest rates, which have been coming down, while long bond yields have been rising. Similar story in the US, but not as bad, really. So despite the US running a fiscal deficit of 6.4%, the market is charging less to lend to the US. Shocking. And the rise in bond yields has not been driven by any rise in inflation expectations. It's been driven by concerns over government solvency. So you've seen the term premium, which actually as recently as last year was negative, has shot up. As Richard said, this could go anywhere. If markets become increasingly concerned about the fiscal pathway in the US, then that term premium could shoot right up. And foreigners are buying fewer treasuries for all the reasons we've outlined. US has undermined its own status as a global safe haven by seizing foreigners' bonds if they don't like you, and also by attempting to cut the current account deficit. And I know to my cost that long bonds have been a spectacularly bad investment over the last 10 years. Okay, so this is the UK 2-year rising again. UK inflation is rising. The last MPC meeting was a 3-way split, hawkish surprise. 10-year actually has been much more stable than the 30-year, but will that hit 5%? Wait until after the budget before dipping your toes in would be my prognosis. See, the 30-year, that just looks like it is rising relentlessly. US 10-year, not too bad, actually. German 10-year, notice how the German 10-year is not rising. France, much worse fiscal position, not rising. Italian, terrible. BBB rated, as we showed earlier, 6% fiscal deficit, lower than bond yields, much lower than us. So actually, what I think this also reflects is the fact that Bank of England is doing QT and there is no natural buyer anymore for 30-year bonds. Greece. Okay, now we're going to go on to the economic data, but I'm going to try and go through this quite quickly because actually, once again, the markets data I think is much more interesting, and the markets do not really seem to be concerned that much about economic data when Donald Trump is firing his mouth off every day.
So the UK CPI month on month, 1.2% in April, above expectations.
Frankly, I was shocked by this number. Terrible, terrible number.
It's a big jump, isn't it? UK CPI year on year, 3.5%, again ahead of expectations and rising trend.
Yeah, trend doesn't look happy.
Core CPI month on month, 1.4%, worse than expectations. Big
Awful.
jump. And core CPI year on year, 3.8%, ahead of expectations.
Honestly, I think core is going to go above 4 in the next few months.
Yeah. RPI month on month 1.7 and year on year 4.5, both much too high. And the rise of CPI inflation is driven by a few one-off factors. There's always a few one-off factors, of course.
Yeah.
Service inflation is strong, and employers are attempting to pass on higher costs due to the national insurance rise, due to the increase in the size of the government.
Yeah. But in particular, Richard, water prices rose by 26%. And vehicle excise duty rose strongly because tax rates for some new vehicles doubled and EVs became liable for tax. Plus, the timing of Easter meant that airfares rose by 27%, which should fall back next month.
Yeah, good points, Keith. So UK is now an international outlier in its inflation levels, and service inflation remained consistently high at 5.4% year on year.
Yeah, and I don't like the look of this chart. That looks to have bottomed, basically, be heading back up.
Yeah, because they're all heading up. So the big picture, UK underlying disinflation has slowed, and let's hope it's not starting to rise again, but it wouldn't surprise me if it does.
Yeah. No, so the Bank of England have this super core services measure, which actually fell in April. The FT's own, that is a nasty looking chart. That looks like it's heading back up.
UK average earnings up 5.5 at 5.5% in March, ahead of expectations.
Yeah, again, just not coming down fast enough.
And excluding bonus, 5.6%, about the same basically. So in the mid fives. 3-month employment change up 112,000. Number of job vacancies continuing to fall. Whether that brings down earnings or not, we don't know, because it hasn't done so yet. UK unemployment rate 4.5%. HMRC payroll change minus 33,000, if we believe it.
Yeah, and once again, if we go back, 3-month employment change, according to the Labour Force survey, plus 112. Yeah. When you actually look at HMRC payrolls, down 72,000.
But also on the HMRC payrolls, March was revised by 31,000, and April's figure was minus 33,000. So it's like 31,000 is the error in the, at least the error in the system. It's like disinformation is bonkers. Number of payrolled employees is clearly moving to a downward trend in the UK.
But that should have brought earnings growth down. It ain't.
No. Claimant count. Well, again, look at the size of the revision in March, which is bigger than the actual March figure.
Absolutely. But they're not seeing a big rise in the unemployment rate.
No. GDP growth quarter on quarter, 0.7%. And year on year, 1.3%. So it's really lackluster.
But better than expected, actually.
And it was aided in quarter one by a big jump in exports. So watch this space for GDP in quarter two. UK exports, there we are. This is just the surge, the pre-tariff surge for non-ferrous metals. Yeah,
so that's not real experts at all,
Movements. And we also had a temporary boost in quarter one from transport investment.
So one-off factors, basically.
Business investment quarter on quarter was 5.9%. And year on year is 8%. So that's actually a fairly healthy level, I would say.
That's great. I'm actually quite impressed with that.
Retail sales month on month, 1.2%, and year on year, 5%.
Yeah, helped by good weather.
productivity growth, 0.2% in quarter one, 0.7% in the last quarter. Too low.
Too low.
Construction new orders up 10.5% in the first quarter. That's good. Construction output pretty much flat for the last couple of years. Industrial production month on month was down in March, as was year on year. So manufacturing is a high productivity growth area because of automation, and we're doing less of it. So that is a drag on productivity growth, and output in UK energy intensive industries hits 35-year low. Why is that, Ed Miliband? Give us a clue. Oh, I know why. It's
Yeah,
because
but
of energy.
I thought the details were pretty shocking, actually, Richard. Between 2021 and 2024, manufacturing of paper and paper products fell 29%. Manufacturing of petrochemicals fell by 30%. Inorganic non-metallic products, including concrete, down 31%. These are not small numbers.
No, these are massive.
These are massive numbers.
That is really, really bad. I mean, it's not just Miliband, it's Sunak et al.
Yeah.
As well. They're all grossly irresponsible. That's completely apolitical because they're all grossly irresponsible. UK manufacturing PMI 45 in May. UK services PMI 50. Composite PMI 49.4. Industrial trends, new orders on a noisy downtrend.
Yeah, they're generally terrible, to be fair.
The retail monitor, retail sales year on year, actually up 7% in April.
Yeah, good weather.
Yeah. GfK Consumer Confidence Index -20 in May, which is actually an improvement on April. Balance of trade, there was an improvement on April, an improvement on February. We don't need to say what the number was, do we, Keith? It was just better than February. No, it was -3.7 billion. PSBR 20.2 billion in April.
Yeah.
Despite tax receipts rising.
Yeah, this is absolutely terrible. So she's raised taxes and the PSBR kept rising because of welfare payments. Just not, it's going to be very difficult to get the UK fiscal deficit under control.
Oh, yeah, I mean, the economic surprise index is going up at the moment. Indeed, job posting index is slightly ticked up.
Yeah, still on a downward trend.
Yeah, and UK wage growth, we covered this really, but 5.5%, which is not consistent really with a 2% inflation target.
It is coming down, but just glacially slowly.
Yeah.
Actually, can I do this?
Yeah.
So this is UK trueflation, and we talked about it. This is from 2 weeks ago, and that was the chart then. And I commented, and I was expecting UK inflation to be surprised to the downside because trueflation was showing actually UK inflation was quiescent, and there was no problem. Well, this is the chart now. What to say?
Not useful, is it really? If it's this,
No.
if it's this inaccurate.
Yeah, it's just they keep on revising the historic numbers. It's ridiculous.
So summary: April inflation hot, pretty disappointingly hot. There were some one-off factors. Average weekly earnings 5.5%, too high. Unemployment rate rose very slightly. Job vacancies are falling. PSBR missed despite tax increases, which is, I think, pretty much a disaster actually. Services PMI bounced back in May. We're going down the stagflationary path as things currently stand.
It all looks bad. Honestly, this is just like the PSBR in particular is just shocking. We've raised taxes and all we've done is push up inflation. Okay, on to the EU. So negotiated wage growth in the EU, that looks great. 2.4%, massive surprise to the downside. Very good for EU inflation. Construction output terrible, down 1.1% year on year in March. Consumer confidence actually ticked back up, but still terrible. Manufacturing PMI actually surprisingly improved despite, the Trump tariffs, etc. Services PMI, though, services main part of the economy, that does not look happy. As a result, the composite dipped back below 50, back in contraction territory. The economic the economic optimism index, though, which is a survey of professional economists, they're seeming more optimistic again. Balance of trade, fantastic in March as everyone rushed to get goods into the US before tariffs. Supplies index, positive. Now, this is interesting. Job postings in Germany continued to fall, but wage growth picked back up. In France, job postings seem to be stabilizing, wage growth also picking back up. Does that mean inflation will pick up? Bottom line, stagnation. PMIs, services PMI falling, but no real problem with inflation in the Eurozone. On to the US, Richard.
Thanks, Keith. So CPI month on month, 0.2%. Year on year, 2.3%. Those numbers looking quite comfortable. Core CPI month on month, 0.2%. Core CPI year on year, 2.8%. And annualized 3-month core CPI is at 2.1%. Shows the various elements making that up. And all measures of US inflation are steadily coming down. So,
yeah, which should mean, my thesis was inflation would come down, bond yields would come down. I got one bit right.
Yes. And fading auto insurance inflation is bringing super core inflation down.
Yeah, that's good news. Something we've extensively discussed over the past year.
Yeah. PPI month on month was down 0.5%.
Yeah, now that is driven by falling portfolio management fees due to the fall in the stock market earlier in the year. That's going to reverse in the next couple of months.
Right. Year on year PPI 2.4%. Core PPI month on month down 0.4%. Core PPI year on year 3.1%. Retail sales month on month up 0.1%, and year on year up 5.2%.
Just fine.
Yeah. Industrial production month on month unchanged, and year on year up 1.5%.
Not great, but better than the UK.
Yeah. Manufacturing PMIs up at 52.3.
Good.
Services PMI 52.3.
Okay.
And the composite PMI 52.1. Michigan consumer sentiment 50.8, falling.
Yeah, not great, actually.
Yeah. Michigan consumer expectations 46.5 and falling.
You do wonder who they survey. If they're surveying, the people who actually answer the phone are, lower income consumers, that would explain quite a lot.
Yeah. Consumer current conditions also falling 57.6. 1 year inflation expectations 7.3%.
Yeah. They're rising, I think, is what you need to take away from this.
Yeah. 5-year inflation expectations 4.6%, so rising sharply. NFIB business optimism index 95.8, so dropping sharply from its little peak.
Yeah, so that Trump optimism fading.
Yeah. Consumers are nervous about their job prospects, which would explain some of the consumer confidence information data. And historically, there's a strong correlation between changes in non-farm payrolls and the Michigan survey. So this Michigan survey suggests non-farm payrolls should start to drop quite sharply.
Yeah, But a lot of correlations have just not proved correct in the last couple of years. Well, watch this
Yeah,
space.
yeah. The conference board leading economic indicator down 1.
Yeah, but it's been falling actually for a long time now. There's been no recession.
Yeah, and the components of the leading economic indicator showing broad weakness in April, so no particular area especially weak. And the LEI is flirting with predicting a recession.
Yeah, well, it was wrong last time,
Yeah.
so
Who knows? It is Chicago Fed National Activity Index down 0.25% in April.
yeah. Thing is, we know the US economy grew just fine last year when it was
Yeah,
negative for most of the year.
yeah. The NHB Housing Market Index falling to 34. Doesn't look particularly healthy. New building permits for 1.4 million, which is looking okay.
Well, actually, that is on, that's towards the lows. I mean, it's not
Yeah, but it's
great.
high. It is, but it's not especially low, is it, Keith? It's
No,
like,
it's not.
yeah.
But,
And housing starts 1.36 million, which is looking okay.
that's looking okay.
New home sales, 743,000, which is looking good.
That's looking good.
Existing home sales, 4 million, not looking so great. Mortgage purchase index, 157.8, which is bumping along the bottom, but still.
Yeah, but actually, rising interest rates have not stopped people taking out mortgages.
Yeah. Initial jobless claims, 227,000, so they're looking okay. Continuing jobless claims, 1.9 million, they're looking a bit on the high side.
Yeah, varies a lot week to week, actually.
Yeah. Indeed, jobs index slightly, a little bit up, 106.6 this week. Wage growth, 3%.
Yeah, great. And perfectly compatible with 2% target.
Yeah. And link up continuing to report declining job openings in the US. The Dallas weekly economic GDP estimate 1.9% this week, 2.5% last week. Atlanta Fed now 2.2%. GDP nowcast 2.4%. St. Louis nowcast 2.4% as well.
Yeah, everyone's saying the US economy is doing just fine.
Yeah. The economic surprise index, draw your own conclusions. And US trueflation 2.1%.
Now, notice it is picking right back up. That is a
Yeah.
big rise in May
Yes.
from April. So that suggests that May CPI numbers are not going to make pretty viewing.
So the BBK leading index turned negative in February and March, suggesting economy may be slowing, but other data isn't.
Yeah, now they look at millions of online data points to get a view of how the underlying economy is going. So let's see.
Yeah. US bankruptcies, yeah, they are higher than they have been, but not excessively. And US hiring rates are lowest in almost 10 years. So not a great time to find a job, but putting pressure on wage inflation. Workers experience good real wage growth.
Yeah, because inflation's quiescent.
Credit spreads are falling. So US trueflation came in soft. The PPI is down a bit in April. The composite PMI was 52.1, so bounced back. And consumer confidence was falling quite quickly with the high inflation fears, but consumer spending is okay. So it's the UK economy does not appear, it's not in recession at the moment. And as pointed out here, if you get this big, beautiful bill passing, that's going to put more money into the economy. So,
Yeah. Okay, thank you, Richard. On to China very quickly. Chinese yuan loan growth continuing to decline. So the China has previously had an investment-led economy. Well, investment growth is slowing. Money supply growth was better than expected at 8% year on year. House prices still falling. They're falling at a slightly slower rate. Industrial production, that looks great if you can believe the numbers, but presumably there was a surge in production pre-tariffs. Retail sales, disappointing in April, 5.1%, lower than expectations. Unemployment rate, 5.1%. Do you believe this? And when you look at the credit impulse, well, it's quite low. The government has not been pumping money into the economy to try and stimulate it in a way that it did in COVID, for example, and during the GFC. It's the Chinese economy is already highly indebted, and they are being quite prudent and not adding to the burden. So bottom line, all the signs are the Chinese economy is structurally weak. We will be doing more on that. Richard has sent me various videos I need to watch prior to the next weekly, which will be in 10 days' time, roughly. And we'll do something on China. Okay, on to one chart. And this chart shows that countries with historically high inflation tend to have higher inflation later. Inflation is a social construct and it tends to be persistent. So on the x-axis, you have average inflation between 2000 and 2009, and on the y-axis between 2020 and 2024. There's a good correlation. Countries with high historic inflation tend to have high inflation. So that's a problem for the UK because we've historically had higher inflation. The markets are going to expect us to have higher inflation again. They're going to charge us more to lend us money. Quiz of the week, Richard. Okay, now this charming robot here is called Gary, the healthcare
Hmm?
robot from Unlimited Robotics. Gary is specifically designed to help nurses with repetitive tasks such as fetching supplies, delivering medications, and transporting patients. Quote, Gary has saved me an average of 2 hours per shift. That's 2 hours that I can now spend providing direct care to my patients, says Olivia Jones, nurse. And I wondered how it moved patients around. Well, there's a video, and basically the robot will drag your wheelchair around the hospital, meaning a nurse or an orderly doesn't have to do it. And once
It's
again,
clever.
yeah, mainly move stuff around, basically.
Yeah, but it's clever, isn't it?
So, quiz of the week. How much does Gary
Twenty
cost?
$20,000. $20,000.
$6,000.
Whoa. Wow.
I think they're coming to a hospital near you pretty
I think
fast.
they are.
Yeah,
Bit of productivity improvement there.
exactly. I think you could see a rise in productivity everywhere.
Yeah.
But that means you're swapping capital for people. And that
Yeah.
means you need to invest a hell of a lot, which means it can only be done if interest rates are lower. Concluding comments. Their normal service will resume in 2 weeks' time, but we're going to cut this short. And thank you all for watching. And just say, basically, it's chaos. Over the past couple of weeks, we've had
Yeah.
China and US agreeing a trade truce, then Trump saying I'm going to impose 50% tariffs on the EU, and then saying no, I'm not. Volatility. This is not good government by any means. The big thing that's happening in the market is bond vigilantes are saddling up. And when I look at the UK, I mean, honestly, the PSBR numbers were terrible. We've raised taxes and all we've achieved is higher inflation, not getting the fiscal balance any improvement in it. So be safe out there. Thank you all very much for watching. And, you know, me in particular, I have not been a good guide to what's going on over the past 3 years, but thank you for sticking with us. So please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.